Good morning, colleagues. It is my great privilege to welcome you today to the BIS conference on Big Tech in Finance, Implications for Public Policy. This high-level conference brings together prominent officials from international bodies, central banks, and supervisory authorities, as well as renowned academics and private sector representatives. It will provide a unique forum to exchange views on the most pressing policy challenges associated with big tech's involvement in the financial sector. Current circumstances have allowed us to invite you to join us in person here in Basel. And it really is a great pleasure to see so many of you here in Basel, and thank you very much for making the effort to be here physically. Needless to say, I also welcome wholeheartedly those who couldn't join us physically and that are being present via technology. We at the BIS have been closely following large technology firms, big techs, and their advances into finance. Big tech's reach extends across a wide range of industries, with existing core businesses grounded in e-commerce and social media, among others. From this base, they have expanded into finance. To understand how big techs can easily make forays into finance, one must grasp the key role of data. Indeed, big techs have fully embraced the centrality of data in the digital economy. This is what distinguishes them from other firms. It also shapes their unique characteristics. Let me mention those that are particularly relevant for policymakers. First, big techs can overcome limits to scale in financial services provision by using user data from their existing businesses. Their business model revolves around users' direct interactions and the data generated as a byproduct of these interactions. They use that data to offer a range of services that exploit the inherent network effects in digital services, a phenomenon where more users attract even more users. In this way, big techs can establish a substantial presence in financial services very quickly through what we have called here at the BIS the data network activities, that is the DNA loop. Second, big techs collect different types of data from the various business lines they straddle. They are uniquely positioned to combine that data to uncover patterns and insights that can help them improve their services or offer new ones. This combination of different types of data across sectors carries efficiency gains and is key to big tech's provision of digital services. Third, big techs are unrivaled experts in data management and analysis. They devote significant resources to developing or acquiring state-of-the-art technologies. After all, access to large troves of data generates value only if you also have the technology capabilities to analyze it and monetize it. Big techs have been pioneers in leveraging artificial intelligence techniques for this purpose. To be sure, these capabilities have high fixed cost, but once that is overcome, the marginal cost of handling more data is negligible. Therefore, big techs benefit from significant economies of scale in their use of data. For other firms, reaping the benefits of such economies of scale is a tall order. Data management is thus at the core of big tech activities, and the financial sector is all about managing information. Coupled with big tech's relentless drive to expand, their growing and already substantial footprint in financial services should come as no surprise. Moreover, the trend towards greater digitalization, which the COVID-19 pandemic has accelerated, has allowed big techs to fortify their market positions even further. Given their size and customer reach, big tech's entry into finance could trigger rapid change in the industry, generating both opportunities and challenges. The potential benefits of big tech's entry into finance include improved customer outcomes, increased financial market efficiency, and enhanced financial inclusion. For example, BIS research has shown that access to innovative QR code-based payment methods provided by big techs helps micro firms build up credit history, and the use of big tech credit can ease access to bank credit. And there are many more examples. But it's not all roses in the garden. The economic features that make big techs powerful in lowering costs and supporting financial inclusion also create new challenges for policymakers. First, data governance. Big techs have large amounts of personal data, and their use comes with a trade-off between data efficiency and privacy. While detailed data may help align products on offer with customer preferences and lower costs, there are risks to consumers, especially when sensitive data are shared. Moreover, big techs can engage in price discrimination, making consumers worse off. Restricting the use of data may help, but could have costs for allocative efficiency. Second, competition is a threat in the presence of big techs. While big techs can initially bring greater competition, network effects allow them to quickly build positions of dominance in specific market segments, for example, by increasing user switching costs or raising barriers to entry. And the resulting concentration dynamics have a direct effect on market contestability and consumer welfare. Thus, new entry may not increase market contestability. Moreover, in the case of network industries, market failures and externalities may arise. Last but certainly not least, there are important financial stability considerations which fall squarely within the mandates of central banks and financial regulators. Let me elaborate on specific concerns around the financial stability risks arising from big techs in finance. One concern centers on big tech's potential systemic importance. Financial services currently represent a relatively small part of big tech's overall activities, but this can change rapidly through the DNA loop. They may quickly become too big to fail. This gives rise to concerns about the emergence of dominant firms with excessive concentration of market power and a possibly systemic footprint in the financial system. A second concern is emerging around the risks from substantive interdependencies inherent in big tech activities. These arise between big tech entities because they share data and provide relevant services to each other. They also share technological platforms and applications and use a common payment infrastructure. Meanwhile, interdependencies with outside parties arise from joint ventures with financial institutions in providing financial services. These partnerships can entail an opaque distribution of responsibilities that diffuses accountability and hinders adequate oversight. They also have the potential to intensify operational, reputational, and consumer protection risks, as well as moral hazard issues. Then there is a third concern around the role of big techs as providers of critical services. Financial institutions have come to heavily depend on big tech technology services, and this is exacerbated by big tech's tendency toward market concentration. While these services bring many advantages, the widespread dependency of them is forming single points of failure, and hence creating new forms of systemic risk at the technology services level. This type of risk is particularly evident in the market for cloud computing, which is highly concentrated and now dominated by a handful of big techs. As a consequence, disruptions in the operations of one big tech could have a substantial impact on the financial system. In other words, greater operational risks can translate into greater financial stability risks, especially when critical services are highly concentrated. The concerns I have just discussed are aggravated by shortcomings in the current regulatory approach, which is not fully fit for purpose to deal with the unique set of challenges arising from big tech's entry into financial services. Most financial activities in which big techs engage are governed by sectoral regulations, and the existing ones can at best partially address the risks I outlined earlier. These regulations are grounded on the main supervisory concerns in each sector, be they the protection of depositors, policyholders, or investors. They were not designed with big techs in mind and therefore are not geared towards possible spillover effects across all the activities big techs perform or their potential systemic relevance. And yet they determine the applicable regulatory treatment for big tech's financial activities, the width of the regulatory perimeter, and the reach of supervisory oversight. Importantly, such regulations tend to follow an activity-based approach, where providers must hold licenses for specific business lines. Activity-based regulation constrains an activity on a standalone basis by imposing restrictions on how it can be performed. It does not vary according to the type of entity that performs the activity. It also does not consider possible spillover effects from other activities performed by the same entity. In contrast, entity-based regulation constrains a combination of activities at the entity level by imposing restrictions on an entity's characteristics that affect the likelihood and repercussions of its failure. Such combinations of activities affect an entity's resilience. The financial stability risks of such combinations cannot be addressed by constraining individual activities without any controls on the critical interactions across big tech entities and their activities. In short, a purely activity-based framework for regulation is ill-suited to address the policy challenges big techs pose. Without a doubt, a regulatory rethink is warranted, and we need a new path to follow, one that considers the key role of data in big tech's DNA-based business model, one that strikes the right balance between benefits and risks. We at the BIS have argued for some time now that we have to go one step further and regulate big techs directly. More concretely, we need to consider how best to complement existing activity-based rules under sectoral regulations with group-wide entity-based requirements that would allow authorities to address financial stability risks emerging from the interactions between the different financial and commercial activities that big techs perform. It is high time to move from theory to practice and consider tangible options for regulatory actions. Now let me attempt to put forward a blueprint for thinking about what such options could look like. Recent BIS publications have identified 3 regulatory approaches that could serve as a basis for a new regulatory framework for big tech in finance. First, the restriction approach would prohibit big techs from engaging in regulated financial activities. It follows the logic inherent in the traditional separation of commerce and banking that prevails in many jurisdictions. This approach radically alleviates financial stability concerns, as big techs would be left only with their non-financial business models or lines. Yet it would deprive them from using big data to solve asymmetric information problems, for example, assigning credit scores to small and opaque firms that do not have collateral. It would therefore remove the numerous benefits that big tech services in finance have brought. Second, the segregation approach would require a big tech's financial services to be grouped together under the umbrella of a financial holding company. This financial subgroup would have to meet prudential and other requirements, and it would be ring-fenced to mitigate the potential for contagion effects from non-financial to financial activities. This could be achieved by banning the use of common group-wide technological platforms and any form of data sharing between the financial and non-financial parts of the big tech group. This approach is conceptually simple, increases the transparency of a big tech's organizational structure, and facilitates oversight. Yet it would prevent big techs from realizing synergies and economies of scale, and from generating insights from data generated across sectors. It would therefore come with some of the shortcomings of the restriction approach. In all likelihood, this would lead at least some big techs to exit financial services altogether. Third, the inclusion approach would make big techs with significant financial activities subject to group-wide requirements on governance, conduct of business, operational resilience, and only when appropriate, financial soundness. This is because most big tech risks are not strictly related to their financial soundness, but their data-driven business model. Requirements would be levied on the group as a whole, including the big tech parent. This approach is tailored to existing business models. It acknowledges the fundamental role of data within big tech groups and their tendency to use them to achieve dominant market positions. As such, it would not prevent big techs from making efficient use of data collected from different activities, like the previous two approaches, as long as they observe sound data governance principles and effective pro-competition rules on a group-wide basis. However, the inclusion approach is more complex than the segregation approach, as it requires effective monitoring of global groups that conduct a large variety of activities. The segregation and inclusion approaches are to some extent mutually compatible, and in practice a combination of both may be desirable. Such a holistic approach could combine a prudential sub-consolidation of the financial part of a big tech group, as under the segregation approach, with group-wide requirements on governance, conduct of business, and operational resilience. Importantly, it would avoid the efficiency losses in the use of data that too tight ring-fencing measures could cause. Regardless of the approach chosen, the implementation of any comprehensive entity-based regulatory framework for big techs is beset with challenges and raises a host of practical questions. One is how to ensure effective cooperation and information sharing between financial data and competition authorities at the local and cross-border level. Another is whether any one authority has the expertise required to serve as lead supervisor for global groups that engage in a wide set of data-driven financial and non-financial activities. Yet another is about enforcement and extraterritoriality, especially when big tech services are performed by entities incorporated in foreign jurisdictions. This, together with unavoidable political considerations, may also explain why progress towards a new framework has been so slow. And I am afraid to say, as we are working on devising an adequate policy response to big techs, challenges will continue to emerge. Innovation never rests, as recent advancements in artificial intelligence and the emergence of quantum computing make clear. But I'm confident that the international community will find ways to address current and coming challenges. To support the research for answers, a thorough international policy debate is essential. After all, international standards are the only way to shape a consistent policy response. As the saying goes, policy making is poetry, implementation prose. But before we can even think of implementation, we need to consider the right policies. This conference offers us a chance to exchange views on these and related issues and to discuss how best to regulate big tech in finance to promote the public interest. In 6 panel sessions, we will hear from central bank governors, leading academics, senior policymakers, and private sector representatives how they think about the operations of big techs in finance, their financial connections with banks, their role as providers of critical services to financial institutions, their involvement in the crypto space, implications for data governance and competition policy, and how the regulatory architecture could evolve to oversee big techs. We hope that this conference will contribute to the international policy discussion, encourage dialogue across the public sector, and help coordinate financial regulation, competition policy, and data protection policy. So now let me give the floor to Hyun, who is our economic advisor and head of research here at the BIS, who will carry on with the first panel. Thank you very much for your attention.